Fire at 45 for American Youth, updated blueprint. $10,000 per month at retirement. Inflation adjusted at 3% per year to $19,091 per month by age 95. New income engine adds OVL and GPIQ covered call ETFs. During growth, full DRIP, dividends automatically reinvested. Emergency cash, toggle DRIP off and use dividend distributions. Retirement. Excess income from OVL, GPIQ, and SCHD reinvested into pure growth ETFs. Estate. Life insurance provides the protection layer. Assumptions. Income is fully inflation adjusted. $10,000 per month at age 45 grows at 3% per year to $19,091 per month by age 95. OVL is the overlay shares large cap ETF, covered calls on S&P 500, yielding 7 to 9%. GPIQ is Goldman Sachs NASDAQ 100 Premium Income ETF, yielding 10 to 14%. During accumulation, all dividends are reinvested via DRIP. Emergency cash is handled by toggling DRIP off. In retirement, excess income is redirected to pure growth ETFs. Life insurance provides the estate protection layer. Blueprint. 8 ETFs now, adding OVL and GPIQ as covered call income ETFs, generating 7 to 14% yield. DRIP is on during accumulation. All income compounds automatically. Emergency cash. DRIP goes off. Distributions flow as cash. Retirement. Excess income from OVL, GPIQ, and SCHD is redirected into VTI and QQQM pure growth. Estate planning now includes a life insurance layer alongside the Roth IRA and step-up basis strategy. Monte Carlo success rate improves to 91% with the higher income yield. Income is CPI indexed at 3% per year. Starting at $10,000 per month at age 45, it grows to $13,439 at 55, $18,061 at 65, $24,273 at 75, and $43,839 at 95. In practice, the portfolio growth at 7% outpaces the 3% inflation drawdown significantly. OVL and GPIQ DRIP compounds powerfully during the accumulation phase. At $685,000 invested with a 10% blended yield, DRIP alone adds $68,500 per year reinvested into more shares, accelerating the compound growth curve dramatically. The inflation schedule is the foundation of income sustainability. Starting at $10,000 per month at age 45, income grows 3% per year, every year, automatically. By age 65, the couple needs $18,061 per month to maintain the same purchasing power as $10,000 today. By 95, $43,839 per month. The portfolio compounding at 7% per year on $3.42 million far outpaces this, generating growth of approximately $239,000 in year one alone versus an income need of $120,000. The surplus compounds and funds all future inflation adjustments. OVL and GPIQ are both covered call ETFs that generate high monthly income by selling call options on their underlying holdings. OVL holds S&P 500 stocks and yields 7 to 9%. GPIQ holds NASDAQ 100 stocks and yields 10 to 14%. The trade-off. In very strong bull market years, their upside is capped because sold call options are exercised. But in flat or mildly rising markets, they outperform. During accumulation, DRIP is on, monthly premiums buy more shares, creating a powerful compounding effect. In a bear market, these ETFs continue paying income even when prices fall, which is exactly when you need cash most. The DRIP on and off toggle is the operational core of the income control system. During accumulation ages 23 to 45, DRIP is on for all ETFs. Combined OVL and GPIQ DRIP income at $342,000 invested is about $68,400 per year, automatically buying more shares. This compounds to an estimated $1.42 million in additional wealth by age 45. Emergency cash. Toggle DRIP off. OVL and GPIQ together on $685,000 invested generate $4,200 to $5,400 per month in cash without selling a single share. Principal stays intact and keeps compounding. Retirement. Selective DRIP. Take exactly what you need for CPI-adjusted income. Redirect the excess into VTI and QQQM, pure growth. 8 ETFs now. VTI, VOO, SCHD, QQQM are the original core, same placement. Adding OVL and GPIQ as the income engine in bucket 2. OVL goes in taxable brokerage and Roth, yielding 7 to 9%, DRIP on during accumulation, off for emergency cash. GPIQ goes in the Roth IRA, yielding 10 to 14% on NASDAQ names, premium income compounds completely tax-free during accumulation. In retirement, excess income from both flows into VTI and QQQM as pure growth reinvestment. VXUS and BND remain in the 401k as before. 4 buckets. Bucket 1, cash, $342,000, 10%, unchanged, covers emergencies. Bucket 2, income engine, $685,000, 20%, now holds OVL, GPIQ, and SCHD. Combined yield of 8 to 12% generates $54,800 to $82,200 per year from OVL and GPIQ alone, plus $23,290 from SCHD. Total income capacity, $78,000 to $105,000 per year. Bucket 3, pure growth, $2.05 million, 60%, VTI, QQQM, VXUS. Only receives money, never distributes. Bucket 4, excess reinvestment, $342,000, 10%, catches all retirement income above the CPI need and auto-buys VTI and QQQM, feeding back into Bucket 3. Total annual investment remains $100,100, but now includes $12,000 per year going into OVL in the brokerage account with GRIP on. At a 7% blended total return including DRIP, the OVL and GPIQ DRIP income alone grows from $12,000 per year at age 25 to over $310,000 per year in DRIP cash flow at age 43, all automatically reinvested. This dramatically accelerates the compounding curve. By age 45, the total FIRE portfolio reaches $4.22 million, of which $3.42 million is investable after the $800,000 home purchase. The cash flow dashboard shows CPI-adjusted income across 4 phases. At age 45, $10,000 per month from brokerage LTCGs, OVL distributions, SCHD dividends, and Roth conversions, effective tax rate 6.3%. At age 59, $13,439 per month, full Roth IRA access makes GPIQ and OVL income completely tax-free, rate drops to 3.8%. At 65, $18,061 per month, HSA now covers medical costs, reducing taxable draw. At 70 plus, $20,938 per month starting, Social Security adds $5,808, and GPIQ plus OVL in the Roth fund most of the remainder tax-free. Note that excess income above the CPI target is automatically redirected to VTI and QQQM in Bucket 4. The Roth conversion ladder now has an added power. Once OVL and GPIQ are converted from 401k into the Roth, their 10 to 14% income compounds completely tax-free. A $100,000 GPIQ position in the Roth generating 12% per year produces $12,000 annually that is permanently sheltered from tax and from RMDs. Over 14 years of conversions, $770,000 is moved at 12% cost, $92,400 total tax paid, versus $185,000 plus at RMD age. And every dollar inside the Roth now earns high covered call income tax-free for life. Adding OVL and GPIQ changes the tax picture slightly. OVL distributions from the taxable brokerage are ordinary income, like bond interest, so they count toward MAGI. We manage this by reducing the Roth conversion amount so total taxable income stays inside the 12% bracket at $68,760. OVL and GPIQ income earned inside the Roth IRA is completely tax-free and does not appear in MAGI at all. Total federal tax, approximately $6,900, same 6.3% effective rate. Zero IRMAA because MAGI stays well below the $218,000 threshold. 5 lines on the chart. The green Roth IRA line now grows faster because GPIQ and OVL DRIP income inside the Roth compounds tax-free, pushing the Roth to $9.02 million by age 95. The amber OVL and GPIQ Bucket 2 line stays relatively stable because excess income is regularly redirected to the Roth. but it still reaches $2.54 million, generating over $25,000 per month in income at 95. The 401k, brokerage, and HSA lines are similar to before. Total estate projection improves to $11.7 million plus from $8.4 million, driven by the additional DRIP compounding power of OVL and GPIQ. Social Security at 70 adds $69,696 per year. OVL and GPIQ inside the Roth generate approximately $94,600 per year at that point, all tax-free. SCHD adds $18,000. Total available income at 70 is $182,296 per year from these sources. The CPI-adjusted need at age 70 is $20,938 per month, or $251,256 per year. Roth draws cover the difference completely tax-free. Excess income above the need is automatically redirected to VTI and QQQM in Bucket 4. 0 IRMAA because Magi stays well below $218,000. The estate now has 3 distinct layers. Layer 1. Life insurance. A $2 million death benefit from a survivorship or permanent policy passes completely income tax-free. Held in an ILIT trust, it also avoids estate inclusion. Term coverage during the 23 to 45 accumulation phase converts to permanent at fire. Layer 2. Roth IRA at $9.02 million. Income tax-free to children, $902,000 per year, each over 10 years still tax-free, with OVL and GPIQ inside, continuing to pay income during the distribution window. Layer 3. Step-up basis erases all capital gains on the brokerage and home at death. Total projected estate, $13.75 million plus. Under the $13.6 million per person federal exemption with the ILIT structure, zero estate tax applies. The HSA strategy is unchanged. $8,750 per year invested in VTI for 22 years at 7% compounds to $548,000 at FIRE age 45. That single account is projected to cover all estimated lifetime medical expenses of $400,000 to $600,000, completely tax-free. The advanced strategy: pay medical costs out of pocket in your 30s, save every receipt digitally, then reimburse from the HSA decades later with no time limit. The HSA balance compounds for 30-plus years first. Monte Carlo success rate improves to 91% from 89% with the addition of OVL and GPIQ. The key improvement: covered call ETFs continue paying income even in bear markets. The option premium income does not stop when prices fall. In a bear market scenario with 4% returns, success improves to 83% from 76% because OVL and GPIQ generate income throughout the downturn, eliminating the need to sell equities. The drip-off mechanism during emergencies adds another layer of protection. Stagflation remains the hardest scenario at 67%. The combination of high inflation eroding purchasing power while returns are suppressed is the primary risk. 8 pillars. Max every account. Correct location, GPIQ in the Roth for tax-free premium income. DRIP during accumulation, $68,000 plus per year automatically reinvested, adds $1.42 million extra by age 45. DRIP off for emergency cash, $4,200 to $5,400 per month, generated without selling shares. Excess retirement income above CPI need goes into Bucket 4. VTI and QQQM, pure growth. Delay Social Security to 70 for 32% more income. Life insurance estate layer, $2 million death benefit in an ILIT. Inflation, index withdrawal by exactly 3% every January. The portfolio at 7% always outpaces it. Getting started guide. Week 1 unchanged. Open all 5 accounts. Week 2 now includes enabling DRIP on all ETFs. This is explicitly the most critical step. The Roth IRA now holds QQQM 50%, SCHD 25%, and GPIQ 25% with DRIP on from day 1. OVL goes into the brokerage with $1,000 per month and DRIP on. Week 3 is new. Obtain term life insurance quotes immediately. $1 to $2 million per spouse for 20 years. At FIRE age 45, convert to a permanent or survivorship policy. Ongoing. Every January 1st, increase the income withdrawal by exactly 3% to match CPI. Rebalance in December. That is the complete American FIRE blueprint. CPI indexed income growing from $10,000 per month at 45 to $19,091 per month at 95. OVL and GPIQ as the income engine. Drip on during accumulation, off for emergency cash, selective in retirement with excess redirected to VTI and QQQM. 4-bucket system with the new Bucket 4 excess reinvestment engine. Life insurance as the estate protection layer alongside the Roth IRA and step-up basis. If this updated strategy helped you, please like and share. Consult a CFP, CPA, and licensed insurance advisor before implementing. Contact senthilkumar.rajendran at ascentfinancialwealth.com for suggestions and improvements. See you in the next one.